Right now, sitting quietly on the IRS website, there are 5 forms that seniors born before 1971 are legally entitled to use. And according to tax professionals who work with retirees every day, the overwhelming majority have never filed a single one of them. Not because they do not qualify, not because the forms are complicated, but because nobody told them they existed. Every one of these 5 forms is free. Every one of them is available today. And for seniors who act before June 30th, the combined financial impact could reach thousands of dollars. Money that is already yours by law, just sitting unclaimed because the right paperwork was never submitted. Before this goes any further, there is one assumption that kills more financial opportunity for seniors than almost anything else, and it needs to be addressed right now. Some people hear the words IRS forms and think this only applies to retirees who are barely getting by. If they feel financially stable, they scroll past. Others hear it and assume this is some complex strategy built for wealthy seniors with investment portfolios and tax attorneys on retainer. If they are living primarily on Social Security, they tune out. Both of those assumptions are wrong, and both of them are expensive. These 5 forms apply to you whether your monthly income is a single Social Security deposit or a combination of pension checks, retirement account distributions, and investment income. Real money is attached to each one of these forms, and the only thing standing between you and that money is whether you file them before the window closes. Here's why these forms stay invisible. The IRS does not send reminders about savings you qualify for. Your tax preparer is not legally required to flag every form you could benefit from, only the ones you specifically ask about. And June 30th is not a made-up urgency. For several of these forms, that date marks the difference between recovering money this year and waiting another full calendar year to claim what is already legally owed to you. Stay through every form today because form number 4 is the one that quietly costs retirees the most money, and it is the one almost no one catches until it is too late. There is something uncomfortable sitting underneath all of this, and it deserves to be said plainly. Every dollar you are over withheld and do not reclaim is a dollar the government holds for free. Every dollar in Medicare surcharges you pay without appealing is a dollar that does not come back. Every dollar in IRA basis you never documented is a dollar that gets taxed a second time as if it were never taxed at all. That is not a conspiracy. That is simply a passive system that rewards the people who know to act and quietly takes from those who do not. The forms exist. The corrections are built in. The appeals process is real. None of it is automatic, and none of it happens unless you initiate it. Most seniors were raised to leave tax matters to the professionals and sign wherever they were pointed. The problem is that approach only works if the professional is proactively hunting for every form you qualify for, and most of the time, they are not. If you have ever looked at your tax return and wondered whether everything that could have been claimed actually was, drop a comment below right now. That tells me exactly how widespread this issue is, and it shapes the follow-up content I produce for this channel. Before form number 1, a quick but important note. This video is for educational purposes only and does not constitute personalized tax or legal advice. Tax law is complex. Individual circumstances vary significantly, and you should always consult a licensed CPA or enrolled agent before taking any action based on what you hear here. What follows is verified from publicly available IRS and SSA sources, but your specific numbers and situation require professional review. Here's what I want you to keep in mind as we go through this list. Later in this video, I'm going to walk you through a real-world scenario. A retired couple from Ohio who reportedly used one of these 5 forms to recover more than $5,000 in a single year, starting the very month after they filed. They had been overpaying for 2 years without realizing it. Keep that story in mind because it is more common than most people think. Form number 1 on today's list is one you may have never heard called by name, but if you are receiving any kind of retirement account distribution or pension payment right now, it is directly relevant to your monthly cash flow. Form W4V is available at ssa.gov, and it controls something most Social Security recipients have never once thought about: the federal income tax withholding on your Social Security benefit itself. Here is what most seniors do not know. Social Security arrives with zero federal withholding by default. The government does not automatically pull anything out for taxes. For some retirees, that is perfectly appropriate. If your combined income is low enough that your benefit is entirely non-taxable, zero withholding is correct. But according to current IRS guidance, a significant portion of seniors born before 1971 have combined income that makes at least a portion of their Social Security taxable. For those seniors, zero withholding means one thing: a bill in April that nobody planned for, sometimes a large one. sometimes with an underpayment penalty attached. Form W4V solves that problem, but it also works in the opposite direction, and that second direction is where many seniors are quietly losing money right now. The form gives you 4 withholding rate options: 7%, 10%, 12%, or 22%. Years ago, when their income was higher, many retirees chose 22% and never revisited it. Their income has since dropped significantly in retirement, but that 22% rate is still running every month, silently pulling more than they owe out of their benefit and parking it at the IRS until April. Consider a scenario like this one. Margaret is 72 years old, widowed, living in Tennessee. Based on information from her prior tax returns, her husband had set up 22% withholding on their combined Social Security years ago when their income was in a higher bracket. Margaret's income today is roughly $28,000 a year. Her actual federal tax liability on her Social Security at that income level, based on current IRS guidance, is closer to 8%. She is being overwithheld by approximately 14 percentage points on a $22,000 annual benefit. That is over $3,000 a year parked at the IRS that should be in her bank account every month. A single W-4V filed directly through her My Social Security account at ssa.gov adjusts that withholding going forward from the month it is processed. No accountant required, no fee, 20 minutes to complete. Form number 2. This one was built specifically for taxpayers age 65 and older, and millions of seniors file without it every single year because their tax preparer never switched them over and their software never flagged the option. Form 104-0-SR is the IRS's designated tax return for seniors, and it is available at irs.gov as well as through every major tax software platform. On the surface, it looks like a cosmetic update, larger print, cleaner layout, but that surface reading misses the important part. Built directly into the structure of the 1040-SR are dedicated sections for the additional standard deduction available to taxpayers 65 and older. The most common income sources for retirees, Social Security and pension distributions, have their own clearly labeled reporting sections, reducing the chance they are entered incorrectly or incompletely. And critically, the form includes the senior bonus deduction in a way that standard 1040 filers can and do miss, particularly when tax software defaults to the regular version without prompting. You can technically claim everything on a standard 1040 that you can on the 1040-SR. But the senior form is designed so the deductions relevant to your situation are in front of you rather than buried in supplemental schedules that a 35-year-old working professional would never navigate. Action step. If you use a tax preparer, ask one specific question before you sign your next return. Ask whether your return was filed on Form 1040-SR. If the answer is no, ask why not. If they cannot give you a clear reason, that conversation is worth having before June 30th. If you use tax software, look for the option to switch to the senior return before you submit. It is usually triggered by confirming your date of birth in the profile settings. Form number 3. Pay attention here because this is the form that catches retirees with IRA history the most off guard, and the dollar amounts involved can be staggering. Form 8606 is filed as part of your annual tax return, and its job is to document something called your IRA basis, the after-tax money you have contributed to a traditional IRA that should never be taxed again when you take distributions in retirement. Here is the situation. Most traditional IRA contributions are tax deductible. You put money in, reduce your taxable income, and pay the tax when you withdraw. Straightforward. But for workers whose income in certain years exceeded the IRS deductibility thresholds, contributions to a traditional IRA were made with money that was already taxed. After-tax dollars going into an account the IRS would later try to tax again on the way out if nobody tracked the distinction. If Form 8606 was not filed consistently during those contribution years, and according to tax professionals who specialize in retirement accounts, it very often was not, then when distributions begin, the IRS has no documented record of that after-tax basis. The custodian reports the full distribution as taxable income. The IRS taxes every dollar coming out as if it were pre-tax money, and the retiree pays income tax on dollars they already paid tax on once. Picture someone like Victor, a 69-year-old retired engineer from Michigan. Over his working years, he made approximately $38,000 in non-deductible IRA contributions during years when his income was above the deductibility limit. His accountant during those years never filed Form 8606. Now, taking required minimum distributions, his custodian reports the full amount as taxable at a federal rate of 22% reportedly. That undocumented basis is costing Victor roughly $8,360 in taxes he never should have owed. According to tax professionals familiar with this situation, amended returns can be filed to establish and document IRA basis going back to the years the contributions were made, but that window does not stay open indefinitely, and it requires action. This form also matters critically for anyone who has done or plans to do a backdoor Roth conversion. Without a filed 8606, the IRS sees no record that the original contribution was non-deductible, and the entire conversion appears taxable on paper, a double taxation event that is both avoidable and irreversible once the tax year closes. Stay focused, because form number 4 is the one I flagged at the beginning, the one that trips up the most retirees, and it directly affects how much tax comes out of your pension or IRA distribution every single month. But first, another reminder. This content is strictly educational. Consult a licensed CPA or enrolled agent for your specific tax situation before filing or amending any return. Form number 4. This is the form that controls your monthly cash flow more directly than almost anything else on this list if you are receiving pension or IRA distributions. Form W-4P is available free at irs.gov, and it governs how much federal income tax is withheld from those distributions each month before the money ever reaches your account. The problem, according to tax professionals who regularly review retiree withholding situations, is that most pension administrators and IRA custodians set a default withholding rate when distributions are established, and that default is almost always higher than what most retirees actually owe. The custodian uses a generic calculation. The retiree never revisits it. 12 months pass. April arrives with a refund check, and the retiree feels good. What they do not feel is the cost of that good feeling, which is that their own money sat at the IRS for an entire year, earning nothing, while they paid out of pocket for groceries, prescriptions, and utilities in the months it was gone. Take a situation like Sandra's. She is 67, single, living in Colorado with a $41,000 annual pension. Her custodian established withholding at 12% when her distributions began. That is $4,920 a year being withheld. Based on her actual deductions, including the additional standard deduction for seniors age 65 and older, and her current income picture, her true federal tax liability on that pension, as of current IRS guidance, is closer to $1,600. The gap between what is being withheld and what she actually owes is approximately $3,320 a year, or roughly $276 every single month that should be sitting in her checking account. Form W-4P is how that gets corrected. Download it from irs.gov, complete the withholding worksheet included with the form, and submit it directly to your pension administrator or IRA custodian. The adjustment takes effect the following month, not next tax season, the next month. That is one of the fastest financial corrections on this entire list. Quick question for the comments before we get to form number 5. Are you currently having federal tax withheld from your pension or IRA distributions? And do you know whether the rate you are being withheld at actually matches what you owe? Yes or no, and tell me your situation in one line. The answers directly shape a follow-up video on how to calculate the right withholding rate for different retirement income scenarios. Now, form number 5. I told you at the start of this video that one form on this list is the one almost no senior has heard of, and that it has the highest per month dollar impact for the seniors who qualify. This is it. And before I explain the form itself, you need to understand the problem it was designed to correct, because without that context, the form does not make sense. That problem is called IRMAA, Income Related Monthly Adjustment Amount. It is a Medicare surcharge, an additional charge added on top of your standard Part B premium that applies to beneficiaries whose income exceeds certain thresholds. Based on information from the Centers for Medicare and Medicaid Services, the standard Part B premium in 2026 is $185 per month for most beneficiaries. But if your income from 2 years ago, specifically from your 2024 tax return, exceeded the applicable thresholds, Medicare is charging you significantly more than that right now. For single filers, reportedly, IRMAA surcharges begin when modified adjusted gross income exceeds $106,000, with the first tier adding $74 per month to the standard premium. Higher tiers climb from there, reportedly reaching up to $443 per month per person in additional charges. For married couples filing jointly, the thresholds are double those for single filers, but the surcharges apply to each spouse separately, meaning the combined annual cost to a couple in higher tiers can reach into the thousands of dollars per year. Here's the trap. Medicare does not look at your current income. It looks at what you reported 2 years ago. So if you retired in 2024, your income that year was elevated, you worked for the first several months, or you took a pension lump sum, or you sold property, or you took a large IRA distribution. Medicare used that elevated 2024 income to set your 2026 premiums. Your actual 2026 income is a fraction of that. You are paying surcharges on a financial picture that no longer exists and will never exist again. That is not an oversight. The Social Security Administration, which handles Medicare premium billing, built a specific correction mechanism into the system for exactly this situation. That correction is Form SSA 44. Form SSA 44 is a life-changing event appeal. It is available free at ssa.gov, and it is how you formally request that Social Security use your current income, not your 2-year-old income, when calculating your premium. There are 8 qualifying life events that make you eligible: marriage, divorce or annulment, the death of a spouse, work stoppage due to retirement, reduction in work hours or income, loss of income producing property, loss of pension income, and receipt of an employer settlement payment in a prior year that temporarily inflated reported income. Retirement alone, simply the fact that you stopped working, qualifies. That is it. Nothing more complex than that. Now let me walk you through the scenario I promised at the start of this video. A retired couple from Ohio, call them Dennis and Patricia, both 68, who reportedly recovered over $5,000 in a single year after filing this one form. Dennis retired from a manufacturing management role in May of 2024. Patricia retired from her position at a regional hospital in August of 2024. Their combined income for 2024, including the months they worked before retiring, came in elevated. Dennis's modified adjusted gross income reportedly at $141,000, Patricia's at $118,000. Medicare used those 2024 figures to set their 2026 premiums. Dennis was placed in the second IRMAA tier, reportedly adding $259.20 per month to his Part B premium. Patricia fell into the first tier, adding $74 per month to hers. Together, based on information consistent with CMS published surcharge tables, they were paying over $333 per month in combined IRMAA surcharges on top of their base premiums. Their actual 2026 income, Social Security for both, plus a small pension from Dennis's employer, was approximately $54,000 combined. They were paying surcharges based on income they had not earned in nearly 2 years and would never earn again. Dennis filed Form SSA 44, citing work stoppage and documenting projected 2026 income with supporting records. Patricia filed her own SSA 44 for her account. Both submitted documentation of their current financial situation. The Social Security Administration reviewed both appeals. Dennis's premium dropped to the standard rate. Patricia's dropped to the standard rate. Their combined monthly savings came to over $333 per month. Annualized, that is nearly $4,000 in premium savings for the year. Because they filed early in the calendar year, they also reportedly recovered excess surcharges already paid from January forward, pushing total savings for the year past $5,000 combined. 2 forms, free from ssa.gov, roughly 20 minutes each to complete. Form SSA 44 can be submitted online through your My Social Security account at ssa.gov, mailed to your local Social Security office, or delivered in person. You can also call the Social Security Administration at 1-800-772-1213 to request the form directly. Once approved, the correction typically takes effect within 1 to 2 billing cycles. Most seniors have never heard of this form. Now you have. Let me bring everything together and give you a clear priority order for what to do before June 30th. If you are currently paying an IRMAA surcharge on your Medicare premium and you have retired, reduced your income, or experienced any qualifying life event since the income year Medicare is using, start with Form SSA 44 at ssa.gov. The monthly dollar impact is highest, the correction takes effect the fastest, and you may be able to recover surcharges already paid this year. Second priority, if you are receiving pension or IRA distributions and you have not reviewed your withholding rate recently or ever, download Form W-4P from irs.gov, complete the withholding worksheet, and submit it to your custodian or plan administrator. The adjustment takes effect the following month. Third, If you collect Social Security and either have no withholding set up or are running a rate that no longer reflects your actual income situation, submit Form W-4V through ssa.gov. You can do it entirely online through your My Social Security account. Fourth, confirm with your tax preparer that your most recent return was filed on Form 104-0-SR, the designated senior tax return, and that the additional standard deduction available to taxpayers 65 and older was applied correctly. Fifth, if there is any history in your past of contributing to a traditional IRA during years when your income was above the deductibility limit, bring Form 8606 into a conversation with your CPA immediately. Undocumented IRA basis does not correct itself, and the cost of ignoring it compounds every year you take distributions. Here's the one idea that ties all 5 of these forms together, and it is the most important thing you can take from this video. Every one of these forms already exists. Every one of them is accepted by the IRS or the Social Security Administration today. The money attached to them is already legally yours. Form W-4V is at ssa.gov right now. Form 1040-SR is in every major tax software platform. Form W-4P is waiting at irs.gov. Form 8606 is required by law for anyone with undocumented IRA basis. Form SSA-44 has been available since the IRMAA system was established. Not one of these forms is automatic. Not one of them results in a check being mailed to you unless you initiate the process. The entire structure of the system is designed so that money stays exactly where it is unless you stand up, file the form, and claim what belongs to you. Do one thing before you close this video. Send it to one person in your life who was born before 1971. A sibling, a neighbor, a friend who retired recently and has no idea these forms exist. A parent who signs whatever their tax preparer puts in front of them and hopes for the best. The odds are strong that they are leaving at least one of these 5 forms unfiled right now. One share from you could be worth thousands of dollars to someone who earned every penny of it. This information reflects the 2026 tax year based on publicly available sources from irs.gov and ssa.gov, verified as of the current date. Tax laws change, and this video is for educational purposes only, not personalized tax or financial advice. Always consult a licensed CPA, enrolled agent, or qualified tax professional before taking any action based on your specific situation. If even one of these 5 forms was new to you today, hit the like button right now. It takes 1 second and it helps this video reach more seniors who need to see it before June 30th. Subscribe and turn on the bell so you do not miss the follow-up videos on withholding calculations and IRMAA appeal documentation. Drop a comment and tell me which of these 5 forms had you never heard of before today, or if you have already filed one and it worked, tell me what it saved you. Every comment gets read, and your experience is the thing that helps the next person who finds this video. You were born before 1971. You worked. You paid into the system for decades. You sacrificed and planned and showed up. The IRS and the Social Security Administration are not going to call you to explain what you are owed. No one is. That responsibility belongs to you, and now you know exactly where to start.